Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello students, hope all of you are doing well. In this video, we will understand and revise Ind AS 103, that is business combination, from an examination point of view. We'll also have a look at a couple of questions that will make you confident in this particular chapter. Now, business combination as such is not tested extensively in the examination, but this forms a solid foundation for you to do consolidation related questions. So, that is why business combination becomes very, very important. And one more thing, students are sometimes quite scared when they talk about business combination, consolidation, because these are big terms which are used by a lot of faculties and students tend to be scared. But let me tell you one thing, if you follow a structured approach in business combination as well as in consolidation, these chapters will never trouble you. Yes, there could be some adjustments which are new, there could be some adjustments which are tricky, but even if you ignore that, you will be able to score good marks in these chapters. So, without wasting much of the time, let us start business combination. Now, when we talk about business combination, what we are saying is there is an acquirer and there is an acquiree. Acquirer, you can say it is a buyer, this person or this entity is a seller. Now, if you learn or if you go back to your amalgamation accounting standard 14, there it is one company acquiring another company, but here it can be one company acquiring another company, it can be one company acquiring business of another company. So, we will also talk about what a business comprises of, right. Now, when it comes to examination part of it, what happens is generally that give you the information about the acquirer and acquiree, and we have to see whether there is control. Whether there is control. So, whether the acquirer has control over the acquiree or not. Sir, how to check control? This control part is governed by Ind AS 110. When we talk about consolidation, there we will understand what is control. But from an examination point of view, they may say like acquirer, let us say A Limited acquires 60% of stake in B Limited, or A Limited acquires 100% of stake in B Limited. So, like this in the question they will tell you what is the control which the acquirer has over the acquiree, and then you will apply the principles of Ind AS 103, that is business combination. Okay. Now, when we say that, let us say A Limited has acquired 60% in B Limited. So, we have said this 60% will give us control. Okay. There could be different scenarios. Let us say A Limited acquired only 15% or A Limited acquired 25%, A Limited acquired 60%. There could be different scenarios of stake acquisition, and depending on what is the stake, our accounting treatment will differ. For example, if you have 15% acquisition, then it is taken as a normal investment and you will follow the accounting principles given under Ind AS 109. Nothing to break your head on. When it comes to 25%, which is more than 20%, and when it is more than 20%, what does it become? It becomes an associate. There is a significant influence. We have understood 20% or more than 20% results in significant influence. There you will follow associate accounting, which is your equity method. This we will discuss separately. Then when it is 60%, more than 50%, when it is more than 50%, this is where we have control. And wherever there is control, we follow Ind AS 103 business combination. So, this standard will cover only those cases where acquirer has control over the acquiree's business. Now, with this understanding, let us quickly go through what all we need to focus on in this particular chapter. The first one is you have to identify who is the acquiring enterprise. Now, this becomes important because in some cases what happens is the acquirer, the legal acquirer may not be the accounting acquirer. This aspect we will understand in something called as reverse acquisition. So, it is important to identify who is the accounting acquirer. Then the next thing is what is the acquisition date. Acquisition date means date on which the acquirer has obtained control over the acquiree. Now, in a lot of cases, what could happen is you may start with, let us say, 10% stake, gradually will increase to more than 50%. In such a scenario, finally, when we obtain more than 50% stake, that is what becomes our acquisition date. And why is acquisition date important? Because all your accounting of business combination will be done on this acquisition date. Then you need to determine the purchase consideration and fair value of net assets. two of the very important steps when it comes to business combination. What is the purchase consideration? What is the fair value of net asset? Please remember, both of these will follow fair value concept under Ind AS 113, and there are some exceptions that we will be covering in this standard. Once you determine the purchase consideration and fair value of net asset, calculation of goodwill and capital reserve becomes simpler, right? So, how do we calculate purchase consideration? First, what is the amount of asset transferred to the former owners? For example, I have acquired Reliance Industries and I paid 100 crores in cash, just for example. That 100 crores is the asset transferred. So, that amount which is paid to former owners, that is the part of purchase consideration. Sometimes I may, instead of transferring cash, I would have given my investment in, let us say, Facebook. I have some investment in Facebook, I have given that investment to Reliance Industries. What is the fair value of that asset transfer? That becomes my purchase consideration. That is the first thing. Sir, where do we get this fair value of asset transfer? It will be given to you in the question. If fair value is not given, book value can be considered to be fair value for examination purpose, right? Then, fair value of liabilities incurred. So, sometimes what happens is, instead of transferring asset, I may, let us say, issue debentures. So, I am incurring a liability, I am giving debentures to the selling company. I gave debentures to Mukesh Ambani to acquire his stake in Reliance Industries. So, if liabilities have been incurred at fair value, that also is a part of purchase consideration. Then, equity interest issued by acquirer. This is the most common way that you see. So, sometimes entities issue equity shares or they may issue warrants, options, whatever meets the criteria of equity, fair value of that is also a part of purchase consideration. Then, contingent consideration, very important, not a contingent liability, this is a contingent consideration. So, what is this contingent consideration? I have acquired Reliance Industries. I told Reliance Industries that if your company makes profit in the next 3 years of, let us say, 100 crores every year, then I will pay you some more amount, right? So, that payment of extra amount is dependent on contingency. So, when it is dependent on contingency, this contingent consideration should also be considered. Now, here one thing you have to keep in mind is, let us say for example, I told Mukesh Ambani, if Reliance Industries makes profit of 100 crores each year for the next 3 years, I will pay you 50 crores after 3 years. Now, this 50 crores is not the value of consideration that you should consider here. You have to see what is the fair value of this, not the present value, fair value. Sir, why fair value? Because the condition may be achieved, the condition may not be achieved. So, as of today, what is the value I am attributing to it? The 10 crores is a part of fair value of contingent consideration, that will be a part of my purchase consideration. Then, sometimes there are deferred consideration. So, we know whenever there is a deferred consideration, we have to consider the present value. If I am paying something after 2 years, 3 years, I will consider the present value and use it for the calculation of purchase consideration. Clear? Very good. Then, special point, fair value of share based payment awards. We will understand how to calculate all of that in the subsequent questions and also as a theory, right? So, this is the purchase consideration. The moment you see an examination question, you have to identify what is the acquirer paying to the former owners in terms of cash, asset transferred, equity issued, liabilities incurred, contingent consideration, future consideration for which you have to calculate the present value, and if there is any SBP awards, right. So, this becomes one important calculation on purchase consideration side. The second important calculation is your fair value of identifiable net assets. Fair value of identifiable net assets. This is nothing complicated. You take all the assets minus all the liabilities, you get the net assets. So, which assets, which liabilities? Which are taken over. Calculate these at fair value. So, where do we get the fair value? Again, this will be given to you in the question, right. So, what you have to do? You have to calculate the purchase consideration and fair value of net asset. Once you have done this, then we can move to the next step, that is calculation of goodwill, right. So, this is the core of any question that you get in the examination. The moment you get a question, what is the purchase consideration, what is the fair value of net assets, then moving on to goodwill calculation. Now, when we have to calculate goodwill, we also need to consider something called as non-controlling interest. So, let us say A acquired 60% in B. With 60% there is control. So, this 60% is called controlling interest and 40% is called non-controlling interest. 60% is controlling interest and 40% is non-controlling interest. Now, whenever there is a control established, when we do the acquisition accounting as per Ind AS 103 or subsequent consolidation, A will prepare something called as consolidated financial statements by considering 100% of net assets of B. So, 100% of net assets of B will be incorporated in this consolidated financial statements. So, this consolidated financial statement will have 100% of A and 100% of B. But sir, we only control 60%? Yes. So, what we will do is, here we will have something called as non-controlling interest, which will tell us what is 40% of B that they take, right. So, this NCI becomes very, very important when it comes to business combination or consolidation. If 100% is acquired, no problem at all, but if only let us say 60% or 70% is acquired, balance amount is payable to NCI or balance amount is attributable to NCI, who are also the owners, and we show it separately on the equity side. That is the non-controlling interest, which is the part which is owned by the outsiders, right. Now, if I say this is B Limited, B Limited has some assets and some liabilities. Assets minus liabilities makes it net assets, right. Now, let us say the fair value of assets is 1000, liability is 300. So, fair value of net assets is 700. Okay. Now, this 700 is not 100% owned by us. Out of this 700, 40% is owned by outsiders and 60% is controlled by us. So, let us say to acquire 60% of this net asset, we paid, who paid? A Limited. A Limited paid 500. A Limited paid 500. Now, this is the owner's side, this is the asset side. We paid 500 to acquire 60% of 700, right. Now, is this entire 700 with us? No. Out of this 700, NCI takes 40%. So, 700 into 40%, 280 is owned by NCI. So, from the 700, actually if you reduce NCI portion, 700 minus 280, how much is left? We are left with 420. This 420 is nothing but 60% of net asset. For 420, we paid 500. This extra amount that is paid, 500 minus 420, this 80 is called goodwill. If I pay extra, that is goodwill. Sir, what if I pay less? If I pay less, there is a gain which is taken as capital reserve, but gain scenarios are very, very rare. Even the standard says if there is a bargain purchase or if there is a gain that is happening, you have to relook at the fair values, right. Now, net asset 700, NCI takes 280, we are left with balance 420 and 500 minus 420, extra amount paid is goodwill. This 40% of 700, what we calculated is what belongs to NCI. This method is called proportion of net asset method. There is another way to calculate where we say NCI 40% will calculate the fair value. So, the entity will assume some factors and all of that, and they will calculate the fair value. Let us say fair value of NCI is 300. So, out of 700 of net assets, 300 belongs to NCI, 400 belongs to us. For 400 we paid 500, this is the purchase consideration, 100 is the goodwill. This is the logic of calculating goodwill. In examination, do not do it this way, do it in the structured manner that I will be showing. So, for calculation of goodwill and capital reserve, first we will calculate what is the purchase consideration, then what is the value of NCI either at fair value or proportion of net assets. Proportion of net assets means from step 3, whatever is the percentage that belongs to NCI, you will consider that, or fair value will be given to you in the question, you will consider the fair value. Now, sometimes students have a doubt, sir, what if they did not mention anything? Then you have to see, have they given fair value of NCI? If yes, use fair value. If they have not given fair value of NCI, then you will use proportion of net assets method. Can we use the valuation used by the controlling entity to calculate non-controlling interest? You should not do that unless the question asks you to do. In all cases where fair value of NCI is not given, you will consider proportion of net asset. But if they have said fair value of NCI and then they have not given fair value, then you can use acquirer's company's payment to determine what is the fair value of NCI. Okay. Now, one more thing that you have to understand is that if we follow proportion of net assets method, we are calculating something called as partial goodwill. Why partial goodwill? Because I am calculating only for my stake. But if I am using fair value, we are calculating full goodwill. This concept will be relevant also when we do impairment of assets under Ind AS 36. Right? So, to calculate goodwill and capital reserve, you will take the purchase consideration, you will take NCI either at fair value or at proportion of net assets, then you calculate the total. This what I say for remembering purpose, this part I will say is the owner's side. Okay, how much they have entitled to or how much they have paid. Then you will calculate what is the fair value of identifiable net asset, including if there is any contingent liability, if you have to do the fair valuation of that. So, you will get two numbers, one is this total, second one is this net identifiable asset. If the owner side what they have paid is more than the net identifiable asset, there is a goodwill. If owner side is less, asset side is more, then there is a capital reserve. Okay. This is the most important step in any business combination or consolidation question. After we have done this, then preparing balance sheet as on the date of acquisition is not at all a challenge at all. Okay. You just need to simply add on the assets and liabilities and the balance sheet would tally. But in this chapter, there are some specific points which we need to understand that can make the examination questions pretty tricky. So far we have understood control of business from examination point of view, purchase consideration, net assets, goodwill or capital reserve, and how do we follow the step to calculate, right? Now, before we move further, a quick recap of the concept that we have learned just now so that the entire framework is set in your mind. Bima Limited acquired 65% of shares on 1st of June in NAFA Limited. So, 65% gives me controlling interest, which is engaged in the production of components of machinery. NAFA Limited had 1 lakh equity shares of rupees 10 each. So, this is the acquiree. The quoted market price of shares of NAFA Limited was 12 on the date of acquisition. Fair value of NAFA Limited's identifiable net asset on 1st of June was 80 lakhs. Bima Limited wired 50 lakhs in cash and issued 50,000 equity shares as purchase consideration on the date of acquisition. So, 50 lakhs in cash, 50,000 equity shares. Whose equity shares? Bima's equity shares. So, when we calculate purchase consideration, this is the first thing, this is the second thing. Sir, what is the value of this? Fair value. Okay. The quoted market price of shares of Bima Limited on the date of issue was rupees 25. So, 50,000 into 25, that becomes my purchase consideration. Bima Limited agrees to pay additional consideration of 15 lakhs if cumulative profit earned by NAFA Limited exceeds 1 crore over the next 3 years. On the date of acquisition, NAFA Limited assessed and determined that it is considered probable that the extra consideration will be paid. The fair value of this consideration on the date of acquisition is rupees 9,80,000. So, as I told you, if there is a contingent consideration, then you have to determine the fair value of contingent consideration. So, that also becomes your purchase consideration. So, here you have 9,80,000, this is one part, 50,000 equity shares at 25 second part and 5 lakh the third part. Then NAFA Limited incurred rupees 1,50,000 in relation to the acquisition. So, one thing you have to keep in mind is if there is any cost of acquisition which is being incurred, that has to be expensed. You cannot show it as a part of purchase consideration. It measures non-controlling interest at fair value. How will the acquisition of NAFA Limited be accounted by Bima Limited under Ind AS 103? Prepare workings and pass necessary journal entry. First, we have to see what is the purchase consideration. Now, here purchase consideration, one is 50 lakhs, then 50,000 equity shares at 25, then contingent consideration of 9,80,000. This 1,50,000, that is not a part of your purchase consideration, that has to be expensed. Okay. So, consideration cash 50 lakhs, 12,50,000 and 9,80,000. So, this is the total consideration, first thing. Second, they have said NCI at fair value. So, what is NCI? 65% is controlling, means NCI is 35%. 35% of what? 1 lakh. They have 35,000 shares. Now, they have not given us the fair value number, but indirectly we can compute. What is the fair value of NCI? Fair value of NCI in this case is considering 12 rupees per share. 12 into 35,000, 12 3s are 36, 12 5s are 60, 4,20,000. So, NCI is 4,20,000. Okay. Then, so this brings us to the total of owners 76,50,000. Then they have said the fair value of net assets is 80. So, fair value of net asset is 80 lakhs. So, a net asset is 80, we paid only 7650, it results in a capital reserve or bargain purchase because assets are higher. So 3,50,000 is the capital reserve. Now, when we have to pass the journal entries, we will incorporate 100% of assets and 100% of liabilities in the acquiring entity. Okay. So, net assets 80 lakhs because they have given us a single number, that is 100%. Then whatever is paid or payable, that we will credit. What is paid? What is paid? 50 lakhs of cash is paid, credit. Equity will be issued 12 lakh 50, credit. Liability on contingent consideration 9 lakh 80. So now 9 lakh 80. Now just think of it. This contingent consideration that will be paid in the future, that will be accounted at fair value. They will credit that. Then this 4,20,000, because we are taking 100% of asset, we have to take NCI as well. So we'll take the value of NCI and the balance amount goes to capital reserve. If there is a goodwill, you will debit goodwill. This entry is in the consolidated financial statements of the entity. In the standalone financial statements, you will just have investment to your cash, equity and contingent consideration. Okay, only that you will consider. But in the consolidated financial statement, you will include the NCI and capital reserve portion, and the expense is 1,50,000. You will write it off. You will not show it in the books, or you will not consider it to be a part of purchase consideration. So the entry: debit all the identifiable assets, credit all the identifiable liabilities, debit goodwill if there is a goodwill, credit capital reserve, credit all the purchase considerations and credit NCI. In the standalone, investment in subsidiary and only the portions that you have issued or transferred, that will be considered. Right? Now, one more thing you have to keep in mind is sometimes there is step acquisition. Initially we acquire 10%, then we acquire another 20%, then 30%, like that we went on to acquire 50% or more than 50%. Now, in such a situation, the existing stake has to be fair valued, and this gain or loss on fair value should be recognized in the P&L. Here also, if asset is transferred, if there is a gain or loss on fair valuation, you will recognize in P&L. Same way, if I have an existing stake, let us say 10% or 20%, and then subsequently I acquired more stake, then this fair value of existing stake should also form part of purchase consideration. Now, after you have calculated goodwill or capital reserve, preparing the consolidated balance sheet is very, very simple. So what you have to do is you just have to add all the assets line by line, all the liabilities line by line, and then after you have passed the initial entry, preparing the combined balance sheet or the consolidated balance sheet is not at all a challenge. So what you have to do is, let us say acquirer is A, acquiree is B. This is the acquiree, this is the acquirer. Okay. So A acquired, in our case let us say 65%. Then what you have to do is, all the assets and liabilities of B will be added to A's consolidated financial statement. All the assets, all the liabilities. Okay. Then you will add goodwill, NCI. Okay. What you will not take is equity. Equity of B you will not consider, and in A's balance sheet if you have investment, this will not be considered. This we will understand in much more detail when we take up a problem, and if you are watching this revision lecture and if you are preparing for the final examination, you would already be aware of that. What you will do is, we will not take investments in the subsidiary, and we will not take the equity of the subsidiary, they get knocked off. We will show the goodwill and we will show the NCI, and then we will prepare the combined balance sheet. Just add line by line all the assets, all the liabilities, and that will be done. Now, the most important part is to understand special cases, and these special cases are also given in consolidated related questions in the examination. So, you have to be very careful in handling these issues. So, now when you talk about special cases or exception, the first one is contingent liability. Now, contingent liability, if you remember India's 37 principles, we do not recognize contingent liability, we just disclose contingent liabilities. But what India's 103 says is, you have to recognize the fair value of contingent liability. I will give you a very small example so that you understand. Let us say you want to buy a house, and on that house there is a court case going on. There is a house and that court case is going on, you want to buy the house. Let us say the house is worth 100 crores today. House is worth 100 crores today. If the court case was not there, house is worth 100 crores. Now tell me, will you pay 100 crores to acquire that house? You will not pay. Why? Because in future if you lose the case, you have to pay some amount. So that court case, what you will do is, what is the amount. Let us say I'll say, okay, 10 crores I'll deduct for that court case and I'll pay you only 90 crores. Okay. Now that is how you factor contingent liability. The owner of the house would not have recognized the court case as a liability. But when you are acquiring, you are saying, okay, your house is worth 100 crores, but I am taking a contingent liability. I am valuing it at 10 crores. So balance only 90 crores is the worth of the house. So whenever there is a contingent liability, you will recognize it at fair value, right? So if it is probable that there will be out of resources, or if there is a present obligation but amount cannot be estimated, even that is a contingent liability, right? You will determine the fair value and you will account for it at fair value. But if there is a possible obligation or you cannot measure it reliably, you will ignore that. Okay. So contingent liability, the question will tell you that there is a probable outflow of resources, you will take the fair value and that will be recognized in the initial acquisition. So where do we take this? This will be a part of like any other liability. This is not a part of purchase consideration. This is a part of any other liability. Right. Then income taxes. What is the exception here? Normally under Ind AS 103 we take everything at fair value, all assets, liabilities, purchase consideration. But income taxes will follow principles of Ind AS 12 and not fair valuation. So we will see what are the various differences, what are the various taxable differences, deductible differences, and considering that we will calculate deferred taxation following principles of Ind AS 12. Okay. And please note, initial recognition of goodwill at the time of business combination, we will not calculate deferred tax on that goodwill component, okay, because it will be a cascading effect. You just need to remember that on goodwill we will not calculate. Then post-retirement obligations, if there are any, will be treated as per Ind AS 19 and not as per fair value of 113 or given under 103. Then indemnification assets. Now indemnification asset, let us say we acquired a business. On this business there is a court case going on. So this court case is a contingent liability, and we say that here there is a contingent liability going on, we do not want to acquire the business. The seller says you acquire the business if your liability subsequently is up to 5 crores, I will pay you 5 crores. What are they saying? You take over this business, and for this court case, if in future you have to pay some amount up to 5 crores, we will bear. Who will bear? Seller will bear. For example, if I acquire Byju's, IndigoLearn is acquiring Byju's. Now Byju's has a lot of court cases going on. So Byju Ravindran says that you acquire the business up to 5 crores, if there is any liability in the future, we will pay against that contingent liability or some other liability. It need not be contingent, right? So this 5 crore is called indemnification. This 5 crore is called indemnification. They are indemnifying us, they are compensating us against a future liability. Now how do we account for this? See, if I am getting reimbursement from somewhere, that has to be my asset, correct? How do I account for this? The standard says, to the extent you have recognized the corresponding liability, let us say the liability is 10 crores, fair value, 5 crores will be reimbursed. So 5 crores you recognize as an indemnification asset. Let us say the liability I recognize only 3 crores. Can I recognize 5 crore of asset? You cannot, because the asset is actually reimbursing a future liability. So the asset value cannot be more than the liability. So the way you have accounted for liability, on the same basis you will account for this particular asset as well. It cannot be more than the liability amount. Okay, so that is what is the indemnification asset. Then assets held for sale. So normally I told you everything is accounted at fair value. Everything is accounted at fair value. But if it is an asset held for sale which is covered by Ind AS 105, you will measure at fair value less cost to sell. You will measure at fair value less cost to sell. You will not measure it at fair value. Please please note this very important adjustment for examination. See, out of this, frequently they keep testing about contingent liability, indemnification assets sometimes, assets held for sale sometimes. Okay, income tax anyways is generally a part of almost all the questions, and post retirement obligations they don't test much. So accordingly, when you are revising, please focus on these specific points so that you remember these for the examination purpose. Then lessee, again not really tested but still. Then leases. If the acquiree is a lessee, acquiree means A is acquiring B, B is a lessee. Now if B is a lessee, as per Ind AS 116, what would have B accounted for? B would have shown a lease liability and right of use asset. Now I am acquiring B. When I am acquiring B, I also need to show right of use asset and lease liability. How do I show it? Lease liability, present value of remaining lease payments as if it is a new lease. So think of it as if it is a new lease, calculate present value of remaining lease payments and determine the lease liability. What is then ROU asset? ROU asset, consider the lease liability plus any favorable, unfavorable terms. So what is this favorable, unfavorable? If the market rental is lower, means I am having a disadvantage. So you reduce that ROU asset as such, so that when you are accounting for right of use asset and also the lease liability, it reflects the true value. Okay, lease liability anyways you have to pay, but let us say there is a lease where the rentals are very high, market rentals are low. So I should not show a high right of use asset, I will show the lower right of use asset. Okay, if the acquiree is a lessor, means the company that I have acquired has given some assets on lease, then you will determine the fair value considering the lease terms. So far nothing much has been tested on this part, but it is good to just remember. Then assembled workforce. Now assembled workforce basically means, let us say if I am acquiring another business, they have some employees. Let's say I acquire TCS, they have 5 lakhs of employees, all of them are trained, they have good skills and all of those things. Can I call them an intangible asset separately? As per Ind AS 38, I cannot. So this assembled workforce should not be recognized separately. You will consider it as a part of goodwill itself. Okay, so whatever is the amount attributable to assembled workforce, even if they give it to you in the examination, you will not recognize them separately. You will say this is a part of my goodwill, right? Then reacquired rights are very, very important. Reacquired rights. Now what is reacquired rights? Just a simple example. Let us say I run a fast food joint, McDonald's. I am owner of this brand. I have given a lot of franchises at multiple different places, franchisee 1, 2, 3, right, and they are running their business, they are doing good. I realize that one of the franchisees is doing exceptionally well, okay, and I think that why should he make money, let me acquire him. So now initially when I had given them franchisee, I had entered into an agreement saying that, let us say, you can use my brand name, you can use my logo, you can use my process, you can use all my recipes, let us say for a period of 10 years at some predetermined amount. Now after 3 years, I say, you leave it, we'll terminate this agreement, whatever penalty is there, I'll pay the penalty, I will take over the business, Now what has happened? This 10 years agreement, I am buying back, along with the business, I am buying back. So if there is any right which the acquirer had given to the acquiree, and because of the business combination they are acquiring back, it has to be valued in a specific manner, right? Now what is that specific manner? We will understand that using an example. ABC Limited acquires PQR Limited for a consideration of 1 crore. 4 years ago, ABC Limited had granted a 10-year license allowing PQR Limited to operate in Europe. The cost of the license was 2,50,000. So at that point of time, it was given at 2,50,000. The contract allows either party to terminate the franchisee at a cost of the unexpired initial fee plus 20%. So it is 2,50,000. 4 years ago means 6 years is unexpired. So 6 out of 10. This makes it 1,50,000. This is the unexpired value. Plus 20% you have to pay, that makes it 1,80,000. ABC Limited has acquired PQR Limited because it sees high potential in the European market and wishes to exploit it. Why should I give it to franchisee? I will only acquire it. Penalty, take this 20% penalty. Okay. ABC calculates that under current economic conditions and at current prices, it could grant a 6-year franchisee for 450. See, unexpired value is 150. Today, if I want, I can give it off at 450. I can give it off at 450, which means 150 minus 450, there is a potential benefit of 3 lakhs to the acquirer, and there is a potential loss of 3 lakhs to the other party because they are surrendering something which has a book value of 150, market value of 450. And at what value? At the date of acquisition, settlement amount is 1,80,000. At the date of acquisition, the settlement amount is 1,80,000. Means if ABC Limited wants to cancel that agreement, they have to pay 1,80,000 and they can cancel the agreement. Now in such a situation, what the standard prescribes is, check 2 things. 1, what is the amount by which the contract is favorable or unfavorable from the perspective of the acquirer when compared with the terms for current market transaction for the same or similar items. So 1,50,000 is the unexpired value, 4,50,000 is the current value. So the amount by which it is favorable or unfavorable for one party is 3 lakhs. Okay, sir, for which favorable, which not favorable, no need to break your head. It is 3 lakhs. 3 lakhs, either favorable or unfavorable, 3 lakhs. Okay. Now against this 3 lakh, what is the amount of settlement provision? 1,80,000. What is the amount of settlement provision? 1,80,000. 3 lakhs, that is the value, 1,80,000 is the settlement provision. Settlement provision means the party who is terminating has to pay. Now, in this case, will the acquiree terminate? No, acquiree will not terminate. The acquirer will terminate and they will pay 1,80,000. Whichever is lower of these two numbers, 3 lakhs or 1,80,000, 1,80,000 is lower. So, you will consider that out of the purchase consideration that is paid to the acquiree, 1,80,000 is to settle this particular contract. Let us say for example, if they pay 1 crore, ABC paid 1 crore to acquire PQR. Okay. Now, ABC when they paid 1 crore to acquire PQR, what we are saying is out of this 1 crore, 1.8 lakh is to settle the existing relationship, 1,80,000 is to settle the existing relationship to cancel that contract, and balance 97 or 98.2 lakhs is the purchase consideration. So, in the examination when you have to calculate, what you have to do is you have to take what is the lower of the two value, that amount is a settlement amount, that is the amount we are paying to settle the existing contract, and the balance amount is our purchase consideration. That is one thing you have to keep in mind. So, if 1 crore is paid, 98.2 lakhs is accounted as consideration for business combination, balance is accounted for as your settlement of the existing contract. Then, so this is also an existing relationship. There could be other existing relationship which is non-contractual. Non-contractual means I have a case filed against, let us say, Byju's. Now, I am acquiring Byju's. I have filed a case against Byju's and I am acquiring Byju's. Now, when I have filed the case against Byju's, I know I will lose the case. And let us say I will have to pay 5 crores to Byju's for that particular case. Now, I acquired Byju's itself for 50 crores. I have acquired Byju's itself for 50 crores. Now, if I have acquired Byju's for 50 crores, I have paid 50 crores thinking two things. One, 5 crores to settle the existing legal battle. Okay, existing legal battle, and balance 45 crores is what I have paid to acquire the business. So, if there is an existing non-contractual relationship, what you have to do is you have to consider the amount payable to that to settle the non-contractual relationship as a deduction from purchase consideration. So, if I paid 50, 5 crores is the penalty amount which I will deduct, and the balance only will be considered to be a purchase consideration. Then, share based payment replacement award. This is again very important, continuously tested in the examination. Share based payment replacement award. Now, what is this replacement award? Let us say I have acquired business of Infosys. Okay. Now, when we acquired business of Infosys, Infosys has their own ESOP plans. Right, they have given some ESOPs to employees, vested, unvested, multiple things would be there. Now, as per the ESOP, the employees have to work for 4 years. Employees have to work for 4 years, and some ESOP has been given. Out of this, 2 years are lapsed, 2 years have passed by, and they have to serve for 2 more years to be eligible to get the ESOP. Now, when I acquired Infosys, I said this existing ESOP, just keep it aside. Infosys will not be even existing. I will give my own ESOPs. I will give my own shares as a part of the share based payment plan. So, what did I do? I said, forget this, let us cancel this out. You serve for 1 more year. You serve for 1 more year, and I will give you my shares. I will give you my shares. What is happening? We are replacing whatever Infosys has given, we are replacing that with our reward or our award. How do we do? In that case, how do we do the valuation? Now, there are 2 aspects. One, now existing has some fair value. The existing award that the employees have, it has some fair value. Out of this fair value, there are 2 parts. One is already completed portion, one is balance portion. Then I gave them my rewards or my awards, which is a new share based payment plan. This also has a fair value, and for this I am saying you serve for 1 more year. Now, how do I split this? How do I account for this? Because subsequent period which the employees will work, that will relate to my remuneration expense. But what they have already worked relates to something where I have an obligation on the date of acquisition. So, if there is a replacement award kind of a thing, how should I do the accounting for? So, very simple. What you have to do is, you have to first take the existing, fair value, that is fair value of original or existing. You multiply that with completed years. How many years have been completed? 2 years have been completed. Higher divided by higher of original or new, means original it is 4 years, new it is 3 years, 2 years completed, 1 more year. So, higher is 4, so 2 out of 4. Pre-acquisition portion, which will be a part of your purchase consideration. If you remember, we had said that there is a fair value of SBP awards, right. So, the part of purchase consideration is fair value of existing multiplied by completed years divided by higher of old term versus new term, right? That will give me the purchase consideration portion. Then I have fair value of new, that minus this pre-combination portion is the post-acquisition component which will be treated as remuneration expense, and that accounting will be done as per Ind AS 102. I am revising once again, fair value of original plus multiplied by completed years divided by higher of original term or new term, that is my pre-combination portion, and balance amount from the new award is my post-combination expense. Very, very important, can be a question in MCQ as well. Then if this is for replacement award, means I cancelled the existing award and I gave a new award, that is a replacement award. If it is a non-replacement award, then what do we do? If it is already vested, I will debit the expenses and I will credit NCI as a reserve. So why NCI? If it is vested means you have to issue shares of the existing entity. Now, if you issue shares, they become a part of your non-controlling interest. So, you will debit expenses and you will credit NCI. If it is non-vested, then you will split between pre and post in similar lines. So, if it is non-replacement, will we have new fair value, old fair value? No, you will just split that based on the number of years. Okay. In examination, mostly replacement is being tested, but even if they test non-replacement, if it is already vested, you will debit the expenses and credit NCI. And if it is non-vested, you will split between pre and post. Pre portion goes to purchase consideration, post portion goes to expenses. Then, how do we do the subsequent accounting for some of these specific items? Contingent liability. Now, as far as contingent liability is concerned, initially you recognize the fair value. Subsequently, what you will do is you will apply the principles of Ind AS 37, and whatever amount comes as per Ind AS 37, that amount or initial amount minus amount reversed or revenue recognized. Out of these two, whichever is higher, you will consider. For example, 100 was the fair value. As per Ind AS 37, now I have to account for only 50. I have to account for only 50 as a provision. But initial amount is 100 and revenue nothing was recognized. So, let us say this amount remains to be 100. So, 50 and 100, what is higher? 100. So, you will continue to recognize at 100. Let us say this becomes 150, then you will recognize 150, higher of the amount. This revenue recognized as per Ind AS 115 generally does not happen, especially it happens in case of, let us say, advance receipt from customers and all of those things, those you can ignore. Then reacquired rights, whatever is the value of reacquired rights, you will amortize it over remaining life. So, the reacquired right that you have acquired, that you will amortize it over a period of life, not very important. Contingent consideration, if liability, remeasure at every period end. If equity, no remeasurement. So, as per Ind AS 109, equity is carried at the initial amount only, you will not do any remeasurement. Indemnification asset on the same basis as indemnification liability. This part generally will not come under Ind AS 103. When you do Ind AS 110 consolidation, that point of time it can trigger, but not very critical from examination point of view, right. Then another very important concept called measurement period. So, what is this measurement period? As I told you, when we do initial accounting, we have to determine the fair value, assets, purchase consideration, liabilities, contingent liability, contingent consideration, so many fair values to be determined. Sometimes time is not sufficient and you have to prepare a balance sheet on 31st of March. So, what the standard says is, you recognize based on provisional amounts. Subsequently, if you are able to get more information to update the fair values, you do that updation. Now, you will do that updation considering that the fair value is on the date of acquisition. For example, I have to determine fair value of an asset. I could not determine it on the date of acquisition, so I recorded it at provisional amount. Subsequently, I could determine the fair value of that asset, so I will update my original entry, or I will update the original calculation of goodwill and capital reserve. This measurement period is there for a maximum period of 1 year. So, if the entity cannot measure fair value on date of acquisition, they can adopt provisional amounts for initial accounting. Then, if subsequent information is obtained, if you obtain subsequent information, you will recognize, remeasure the assets and liabilities. So, initially I had recognized an asset at 100, subsequently it became 110, I will increase the asset amount. Now, if I am increasing the asset amount, I have to reduce something else. So, I will reduce goodwill or I will increase the capital reserve. So, let us say if I debit asset, correspondingly I have to credit goodwill or capital reserve. If I debit a liability, correspondingly I have to again adjust the goodwill and capital reserve, right. One important thing is the information must relate to condition existing on the date of acquisition. So, whatever new information you get in that measurement period of 1 year, it has to be for conditions existing on the balance sheet date. For example, there is a contingent liability. Now subsequently after 6 months the court has decided, that is not a part of adjustment because of measurement period. Okay, so that you will have to consider as a part of updation of contingent liability. But if you could not determine the fair value of contingent liability, subsequently you calculated the value of contingent liability, then that has to be updated, right. So this covers major part of adjustments that are to be done when we do business combination. Now there is one more aspect which we have to understand, that is payment to owners. Say for example, IndigoLearn, we sold it to some other company, okay, and what I did was, I am an employee of the company, I have resigned from the organization, directors and employees, the shareholders, employees, we have resigned. If all of us resign, do you think the other party will be able to run the business? Because they will not understand anything out of it. They will not understand how do forums work, they will not understand how do the backend team works, they don't understand how do our access works, content works, they will not understand anything. So what they will say is, Suraj, Sriram, what you do, you cannot leave immediately, you have to work with us for 2 years, you have to work with us for 2 more years, and then only you can leave the organization. So subsequently they are paying something to us for working for 2 years of employment. They will pay us some salary. This salary that is paid, see, we are shareholders and we are employees. The salary that they are paying, are they paying for us as employees or as shareholders? They are paying because we are employed. So if any payment is made for the capacity or in the capacity of employment, then that is considered to be a part of your normal salary expenditure. But if they say that in the next 2 years, if you achieve some specified amount of revenue, then we will pay some more consideration because you are the owners, then that is in the capacity of shareholder. So if they are paying something in the capacity of shareholder, this becomes my purchase consideration. But if they are paying something in the capacity of employment, then that is not purchase consideration. This is one more adjustment which can be tested in the examination. Now what we will do is, we will take a few questions, quickly revise them, and then we will move to the basic conceptual part, what is a business, what is asset acquisition, concentration test and relevant aspect. Then we will conclude with reverse acquisition and common control transactions. So now that we have understood the concepts of Ind AS 103 and business combination, let us have a look at a couple of questions to be perfect with these concepts. Please note, I am not going into depth of each of the questions or each of the adjustments. This is more from a revision point of view. The balance sheet of Professional and Dynamic Limited is given below. So in any examination, when you have a question on business combination or on consolidation, they will give you a balance sheet. One will be the parent entity, another one will be the subsidiary entity. You may have to prepare the consolidated balance sheet as on the date of acquisition or on a subsequent date, right? Here we are seeing date of acquisition. In the next chapter, that is consolidated financial statements, we will see how to consolidate at a subsequent date. Now one thing to save time in the examination, what you have to do is, while reading the question, these amounts that are given, they are not really important immediately. They are important when you are solving the question. So don't waste time reading, okay, 300 here, 500 here, all of that is not required. This is amount in lakhs. No need to waste time in reading the amounts. Just scan the balance sheet and see, is there anything unique, new, different which you must be aware of. So property, plant, investment, current assets, all of these are normal items. Equity, this becomes important because this will determine the stake and control. Share capital, equity shares of 100 each of Dynamic Limited and 10 each of Professional Limited. So you have Professional Limited, you have Dynamic Limited. Face value of Professional is 10. See the way they have given the question. First they have given Dynamic, and then they have given Professional. So you have to be very careful while reading the question. So this is 10 and this is 100, means this has 50 lakh shares and this has 4 lakh shares in count. Okay. Other equity is given. Then you have non-current liabilities, financial liabilities, borrowings, deferred taxation, current liabilities, financial liabilities, short-term payables and all of that. So all of these are normal items. Now Professional Limited acquired 70% of Dynamic Limited on 1st of April by issuing its own shares in the ratio of 1 share of Professional for 2 shares of Dynamic. How many shares did we calculate? 4 lakh. So we have calculated 4 lakh shares. How many have we acquired? We have acquired 70%. So 7 into 4, 2.8 lakhs we have acquired. For this, divided by 2, we will give 1.4 lakh shares. The fair value of shares of Professional Limited was 40 per share. So whatever consideration you gave, you will account for them at fair value. So we calculated 1.4 into 40, 56. The fair value exercises resulted in the following. Fair value of PPE on 1st of April was 350 lakhs. How much was it here? 500 lakhs. It has come down by 150 lakhs, now it is at 350 lakhs. Now one thing that you have to understand is, whenever there is a fair value difference or fair value changes on the date of acquisition, that can create a deferred tax implication if at all the tax rate is given in the question. So you have to keep that in mind, that from 500 it has come down to 350. My book value is less, my tax value has become higher. My book value is less, my tax value has become higher, because tax will continue at 500 and asset in my books is now being shown at 350 only. Means what? I'll get more deduction in tax, which will create a deferred tax asset. So this will result in a deferred tax asset, right? Then Professional Limited also agreed to pay an additional payment as consideration, that is higher of 35 lakhs and 25% of any excess profits in the first year after acquisition. Now what is this? This is a contingent consideration which you will pay in the future. Now here minimum I have to pay 35 lakhs. See, whether though they are saying higher of 35 and 25%, I don't know the 25% number, but I know 35 lakhs. Minimum I have to pay 35 lakhs. So what you will do? You will take this 35 lakhs and take in your calculation. After acquisition, over its profits in the preceding 12 months made by Dynamic Limited, this additional amount will be due after 2 years. So it is a contingent consideration and also it is a deferred consideration. You will pay 35 lakhs after 2 years. You have to bring that to present value discounted by the factor whatever they have given. I think it is given at 10%, so 1.1 into 2 times, right? Then Dynamic Limited earned 10 lakhs profit in the preceding year and expects to earn another 20 lakhs. Now don't get confused with this. They are saying 10 lakhs in the preceding year and expects to earn another 20 lakhs in the subsequent period. That is not relevant for our calculation, because we know minimum we have to pay 35 lakhs. Minimum we have to pay 35 lakhs. In addition to above, Professional Limited also had agreed to pay one of the founder shareholder a payment of 20 lakhs provided he stays with the company for 2 years after the acquisition. As I give you an example, if someone acquires IndigoLearn and they say, Suraj, you have to work with us for another 2 years and for that we will pay you how much? 20 lakhs per annum or 20 lakhs in lump sum. We will pay you that amount. Of course, I will not go for 20 lakhs, that is for sure, right? If we will pay you that as an employee, we are not paying you as a shareholder, we are paying you if you work for us. So that is a payment towards employment. Will this be a part of purchase consideration? No. But if they say it is towards shareholder, we are paying because you are the owner, then it will form part of purchase consideration. Dynamic Limited had certain equity settled share-based payment. This point will clarify how to do the adjustment. Share-based payment award, which is the original award, which got replaced by the new awards issued by Professional Limited. So there is a replacement award. As per the original term, the vesting period was 4 years. Original term is 4 years. As of date of acquisition, and employees have already served 2 years. So out of 4 years, 2 years have already been served. As per the replaced award, the vesting period has been reduced to 1 year. So now the new vesting period or the revised vesting period is 3, original is 4. We will take higher, so we will consider 4 years. As per the replaced award, vesting period has been reduced to 1 year. Fair value of the award on the date of acquisition is as follows. Original award is 5, replacement is 8. Now how do we do this? This one adjustment can come in MCQ as well. So you have to be very, very careful. How will we do? This 5 lakhs will take higher of these two, 4, and 2 years have been completed. So 2.5 pertains to the period which is already completed. 2.5 pertains to the period which is already completed, and out of this 8 lakhs, 2.5 will be the pre-combination and 8 minus 2.5 will be the post-combination or employee expense. So 2.5 will form part of my purchase consideration. Dynamic Limited had a lawsuit pending with a customer who had made a claim of 50 lakhs. Management reliably estimated the fair value of the liability to be 5 lakhs. Now we know that if there is a contingent liability as per Ind AS 37, do we recognize? We do not recognize. As per Ind AS 37, we will not recognize any contingent liability, correct? But the fair value of the contingent liability will be recognized as per Ind AS 103. So this 5 lakhs will be recognized. We are creating a liability. But do we have a liability for the tax purpose for this thing? We do not have. So this amount, the difference between 5 and 0, that will also have a deferred tax implication, right? The applicable tax rate is 30%. You are required to prepare opening consolidated balance sheet of Professional Limited on 1st of April, assuming 10% discount rate, right? Now here, what do we need to know? We need to know the purchase consideration. Now purchase consideration, if you see, One is we have already calculated this 56 lakhs of purchase consideration shares issued. Then deferred consideration 35 divided by 1.1 2 times 28.93. Replacement award 2.5 we have already calculated. All this becomes my purchase consideration. Please note, this amount which is paid, which is towards employment, is not a part of my purchase consideration. That is one thing you have to keep in mind, right? Then the next thing is, what is the fair value of identifiable net asset? Now there are two ways to do this. One, you take Dynamic Limited and figure out what is their net assets in terms of share capital and other equity. That is 400 plus 225. If you see, that becomes 400 plus 225. If I do, I get 625. To this, do the fair value adjustment. What is the fair value adjustment? PP is down by 150, so minus 150. Then there is a contingent liability of 5 which comes up, minus 5, right? So minus 150 minus 5. So how much is this? 625 minus 150 minus 5. If I do, I get 470, right? So 470 is the identifiable net asset, and there is a deferred tax impact of this. What is the deferred tax impact? One, there is a asset decreased by 150. When asset decreases in book, or if the carrying amount is less and the tax base is higher, it creates a deferred tax asset. So if asset is reduced in my books, it creates a deferred tax asset. We have learned this in Ind AS 12. Similarly, if a liability increases, that also creates a deferred tax asset, right? So asset reduction, liability increase. So put together 150 and 5, we have 155. Of this, if I do 30%, I get 150, 155 into 0.3, I get 46.5. This 46.5 is my DTA. So what I can do, 470 plus 46.5, that becomes my net asset. So this is a quicker or a shortcut way to calculate. Take the total equity, do the fair value adjustments and defer taxation impact. But it can create a confusion in the examination. So what you can do is, you can take the book value and the fair value and calculate line by line. So only PPE is different, all of these are same. So now here 500 minus 350, book value is higher, fair value is lower. This becomes my carrying amount, this is my tax base. 500 minus 350, 150 will create a DTA, right? Same way plot all the liabilities, and here this is also creating a DTA because the liability as per books has become higher and the liability for tax purpose is lower. So 155 will create DTA, we get 46.5, same number. If you add both of these, you get 516.5. This is the identifiable net assets. So the net asset acquired is 516.5. Now this net asset acquired, what you will do is, you will compare with what you have paid, 87.43 plus the non-controlling interest. How much we have paid plus what is the non-controlling interest, that you will compare with 516.5. So when calculating, your purchase consideration is 87.43 that you have paid. Value of NCI, they have not given fair value, so we will take proportionate of 516.5, we get 154, this becomes my total, and fair value of net asset is 516, the difference 274 becomes my capital reserve or gain on bargain purchase, right? So till here, if you do it correctly, preparing consolidated balance sheet is not a problem. Now one more thing I want you to understand is, all of these things that you are doing, purchase consideration, identifiable net asset, or what you are doing here in this calculation of goodwill, goodwill or capital reserve, all of these have to be adjusted in the balance sheet. So once you do these adjustments in the balance sheet, your balance sheet will automatically tally. There is no question or there is no doubt about why will the balance sheet match or not match. Okay. So fair value of purchase consideration 87.43. What is the breakup? 87.43, there is a breakup of shares issued 56 lakhs. So this you will add it to share capital plus securities premium. Then present value of deferred consideration 28.93, this will become your liability, non-current liability. Then replacement award 2.5, this you will add it to again equity, right? So all of these have to be treated, shares issued, whatever is done, all of these have to be adjusted in the balance sheet, right? Then identifiable net assets, whatever you have calculated, this 516.5, this fair value of net assets identified, fair value of net assets acquired should also be adjusted. Now how will we adjust this? We will simply add dynamic fair value. Whatever is the fair value of assets of dynamic, line by line when we add, this automatically will be taken care. Then you have this NCI that we have calculated here, this has to be shown in the balance sheet. Then gain on bargain purchase has to be shown in the balance sheet. If you do these adjustments and add the balance sheets together, your balance sheet will always tally. Now what are the things we should exclude? That also you should be aware of, and I hope you are aware of those. You have to exclude the share capital and equity of the subsidiary company, because that is something which you will incorporate indirectly by way of net assets, and investments in subsidiary that you will show. Now here there is no investment because we have not yet made the investment. If investment in subsidiary is shown here, that amount you have to exclude. Okay. So by considering that, it's a very simple balance sheet preparation. So PPE 300 plus 350, that is 300 of this and 350 fair value of this. Like that you have to add all of these items line by line, inventories, trade receivables, cash, others, all of them line by line. Then equity and liabilities. Now what has happened here? Already we have 500, we have issued another 1.4 lakh shares, this is 14. So 514 should be added. Now sir, fair value is 30, this 30 into 1.4 will come here as securities premium, right? Then SBB reserve, this is your share based payment award. Capital reserve, this is your gain on bargain purchase. Then one more thing, NCI you will put it here. Okay, so other equity comes up, equity came up. Then long term borrowings line by line, deferred consideration, the present value that you should show it as a liability. Then long term provision, deferred taxation, whatever you have calculated, that you should incorporate. Now here what you have to keep in mind is, how do we get this number? You just come over here, you have deferred tax under liability 40 plus 35. Now you have created a deferred tax asset, so 40 plus 35 minus whatever is the deferred tax asset, right? 40 plus 35 minus the deferred tax asset. So 40 plus 35 plus deferred tax asset, you get this here, short term borrowing, trade payables, and provision for lawsuit, the liability which got added 5. This when you take, you get the total. Balance sheet tally should not be a problem. Now one more thing what a lot of students do is, whenever they see these questions on 103 and 110, somehow there is a fear, right from say intermediate level, there is some kind of fear that what if the balance sheet does not tally, what happens if the purchase consideration goes wrong. Now one thing you have to keep in mind is, even if a couple of adjustments goes wrong, unless you are making mistakes at all the level, even if a couple of adjustments goes wrong, what you have to understand is, this balance sheet, consolidated balance sheet will fetch you 4 to 5 marks. If you make a couple of mistakes, at least 3 marks you will get here. Okay. Then purchase consideration, if you do it correctly or half correctly, 1 or 2 marks you will get there. Then notes to accounts you will get 2 to 3 marks, right? Calculation of NCI you will get some marks, calculation of goodwill you will get some marks. So here and there put together, if it's a 15 marks question, even if you make a couple of mistakes, 10 marks should be in your pocket. So don't be scared, just even if you don't do anything, just if you add the balance sheets, consolidated balance sheets, and if these numbers are partly correct, you will get marks for that. So if you find it really difficult, then you can do it towards the end, but don't ignore or avoid this particular topic. 103 and also 110. Now let's look at one more question. This will clarify some more aspects related to purchase consideration and what we should consider. And then the remaining questions, this material is available, the past exam question papers are available. You can have a look at them and you can solve them. H Limited acquired equity shares of S Limited, a listed company, in 2 tranches as mentioned in the below table. 1st of November, 1st of January, step acquisition. First 15%, then 45%. So this becomes 60%. On this date, control is established. Now the moment you say step acquisition, what should come to your mind? First, existing stake, I will do a fair value. Whatever is my existing stake, I will do a fair valuation of that. That is the first thing, right? Then fair value of this plus whatever is paid here, that becomes my purchase consideration. Then I will add value of NCI to that. That I will compare with net asset to calculate goodwill or capital reserve, right? Both the above mentioned companies have rupees as their functional currency. H Limited acquired control on 1st of January. Even if they don't say, you should be aware of it. Following is the balance sheet as on that date. So the balance sheet of only the subsidiary is given, all the assets have been given, right? And share capital is given, all the assets have been given, and they have also given the fair value here directly. Okay. Then following is the statement of contingent liabilities of S Limited. Lawsuit filed by customer for a claim of 2 crores, fair value 0.5. It is not probable that an outflow of resources embodying economic benefits will be required to settle the claim. Now what does this mean? It is not probable means as per Ind AS 37 you cannot recognize, but as per Ind AS 103, even if it is not probable, if you can determine the fair value of the contingent liability, you should measure the fair value of contingent liability. Income tax demand of 7 crores. Raised by tax authority, they have challenged, it is not probable, but again 2 crores will be the fair value. So both of these you have to consider. Then any amount which will be paid in respect of lawsuit will be tax deductible, Means if you pay some amount in the future towards this lawsuit, it will be tax deductible. Means what? I am recognizing a liability. Currently, there is no tax base. There is no tax base. When will I get a deduction in tax? When it will be paid. So right now the tax base is 0. In the books I am showing a liability. So definitely there is a deferred tax implication. It will create a deferred tax asset, right? In relation to the above mentioned contingent liabilities, S Limited has given an indemnification undertaking, indemnification asset up to a maximum of 1 crore. So whatever comes here, up to an amount of 1 crore, the subsidiary, the selling company will reimburse. Means what? What will be our indemnification asset? To the extent of 1 crore. Rupees 1 crore represents the acquisition date fair value of the indemnification. Any amount which would be received shall not be taxable. So if it is not taxable, the tax rate becomes 0. Does it have a deferred tax amount? No, it will become 0. The tax base of asset and liability is equal to the respective carrying values being recognized in the balance sheet. So this is the tax base. This is now the new carrying amount. Carrying value of non-current asset held for sale rupees 4 crore represents its fair value less cost to sell in accordance with the relevant Ind AS. Now here what you have to understand is, there is this item called non-current asset held for sale. This is fair value less cost to sell. This is the fair value. Now we have seen under the exceptions that we will recognize it at fair value less cost to sell and not at fair value. So we will take only 4 crores for calculation purpose. In consideration of the additional stake purchased by H Limited on January 1st, 2007, it has issued to the selling shareholders of S Limited 1 equity share of H Limited for every 2 shares held in S Limited. Fair value of equity shares of H Limited is 10,000 per share. So fair value of H is 10,000. H will issue for every 2 shares. How many shares? 1 share. So coming back, share capital face value is 100. Share capital face value is 100. So these amounts are given in crores. Okay. Share capital face value is 100, which means 12 crores divided by 100. How many shares do you have? 12 crores divided by 100, 0.12 crores or 12 lakh shares. Okay. Now out of these 12 lakh shares, how much are we acquiring? 45%. So 12 lakhs into 45%, if I do, 12 4 is 40, 12 5 is 60. So it becomes 5.4 lakhs. Number of shares 5.4 lakhs. For 5.4 lakhs divided by 2, I will issue 2.7 lakh shares. 2.7 lakh shares multiplied by the fair value 10,000, that becomes my purchase consideration. So when you calculate the purchase consideration, fair value of shares issued, you can see the working note here. Total shares is 12 lakhs. New purchase 45%, 5,40,000. 5,40,000 shares we have issued 270 into 10,000. This becomes 270 crores is the purchase consideration, right? Be slightly careful in calculating because of the number of zeros involved. 270 crores becomes the purchase consideration towards shares. There are other purchase consideration also. On January 1st, S Limited paid 50 crores. This also gets added in cash to the selling shareholders of S Limited. Additionally, on 31st March, S Limited will pay 30 crores to the selling shareholders if the return on equity of S Limited for the year ended 31st March is more than 25% per annum. They estimated the fair value of the obligation on 1st of January and 31st of March at rupees 22 crores and 23 crores respectively. Now what is this? This is a contingent consideration and we have to take fair value on the date of acquisition, which is 22 crores. So what do we do with this 23 crores? Now that 23 crores is a change in liability. Subsequently you have to account for it. Okay. Quoted price of equity shares of S Limited on various dates are given below. On November 350, 1st of January 395, 31st of March 420. For us, what is relevant? For us, this 395 is relevant for the purpose of calculating fair value of existing stake. So whatever is the fair value of existing stake, that you will multiply by 395 and you will get the valuation. So whatever is the existing stake, you will multiply with the fair value and get the fair value of the existing stake. On 31st May, H Limited learned that certain customer relationship existing on 1st of January, which met the recognition criteria of intangible asset, were not considered during the accounting for business combination for the year ended 31st March. The fair value of such customer relationship on 1st of January was 3.5. Assume there are no temporary differences associated with the customer relation. On 31st May, H Limited further learned that due to additional customer relationship being developed during the period, the fair value of such relationship has increased to 4 crores as on 31st March. Now, what does this mean? We understood a concept of measurement period, that as on the date of acquisition, if we are not able to determine the fair values, we can do the accounting on provisional basis. So, what we have done on provisional basis we have done. Subsequently, we figured out that on 1st of January, there is a customer relationship on the value of which on 1st of January is 3.5 crores. Now, very carefully you have to understand, I cannot bring in any new asset which did not exist on that particular date. Did this customer relationship exist on 1st of January? Yes, it did exist. What was the value of that? 3.5 crores. Now, that this 3.5 crores, you will have to subsequently update the value. You are increasing an asset, you have to reduce something else. Either you will reduce the goodwill or you will increase the capital reserve. Now, they also say that subsequently it became 4 crores on 31st March. Now, this is because of new work. This is not the condition existing on the balance sheet date. You can take only the conditions existing on the balance sheet date. Any information related to condition existing on the balance sheet date you can consider, and you can do the valuation. Subsequent improvements, subsequent efforts, subsequent changes we will not consider. So, this 4 crores will not be considered. What we will consider is 3.5 crores, and this will become a part of my asset in the calculation. Now, one thing they have said is this does not have impact on income taxes. So, we will ignore for deferred taxation. On 31st December, H Limited has established that it has obtained all the information necessary for the accounting for business combination, and more information was not obtainable. So, just that we will update the customer relationship value and adjust the goodwill accordingly or capital reserve accordingly, and also the NCI component. H Limited and S Limited are not related parties, they follow Ind AS and income tax is 30%. You are required to provide your detailed responses to the following. What should be the goodwill or bargain purchase to be recognized by H Limited in its financial statement for 31st March? Measure non-controlling interest using proportionate share. Will the amount of NCI goodwill or bargain purchase change subsequent to 31st March if yes, provide the journal entries? What should be the treatment of contingent consideration on 31st March? So, here the reason why I am discussing this question is this talks about 2-3 important things. One, the contingent consideration. It is a liability, subsequently we will update the liability, but we will not update the goodwill or capital reserve because of that. Second, for the customer relationship, which is an asset which we did not recognize earlier, for the conditions existing on the acquisition date, we will recognize. So, when we recognize a new asset, we will adjust the goodwill and NCI subsequently, right. So, these are the 2 things which you have to keep in mind while solving this question as a part of your revision. So, purchase consideration part, the first part is fair value of existing stake, 711, that is, you can see the working note here, 15% 1,80,000 into 395, 7 crores 11 lakhs, okay. That is the fair value of 15% stake. Cash paid 5,000. The reason why I used 5,000 is to represent everything in lakhs. Okay. So, if I remove these 2 zeros, it becomes crores. Then fair value of deferred consideration 2,200. What they have given here? This number. This will be used to update the liability, but that will not be used to update the values as on 1st of January. Okay. It is not a measurement period adjustment. Then this makes the total on the purchase side. Second, fair value of net assets acquired. So, here what you can do is, because there are a lot of fair value changes, take the book value and fair value and difference just plot it. Now, the best way to do this in the examination is do book value minus fair value. Do book value minus fair value. If it is a negative number, this will create a DTL. If it is a positive number, it will create a DTA. So, DTL, 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 then this here all of these there are no changes. Indemnification asset 100. There is no DT impact because the question says there is no income tax consequence. Total assets done, then borrowing, trade payables, provision for warranties, current tax liabilities, fair value of lawsuit, a new item that has come into existence, that we have increased the liability. Now, this will create a deferred tax asset. Okay. Then fair value of tax demand 200, this they have said there is no DT impact. So, basically 31,000 on the DTL side and 50 on the DTA side. If you do, you get 30950. This if you multiply with 30%, you get 9285. This you will plot it as a DTL. And by doing this, you will get the net assets of 36,685. NCI 40%, 14,746, 40% of this. So, NCI Purchase consideration plus NCI, if you compare with fair value of net asset, it is higher. So, this becomes the goodwill 12,792, right. Now, you can look at the detailed solution in the notes given. I am just explaining you the sequence. Now, after this is done, they have said a new asset has come 350. Now, when this new asset has come, parent will take 60%, subsidiary will take 40%, or sorry, NCI will take 40%. So, 350 into 60%, 210. You are increasing the asset, you will reduce the goodwill. Second part, here you will increase the NCI. So, bring the new asset and reduce the goodwill and increase the non-controlling interest. Okay. Then any changes from 1st of January till 31st of March, because of our efforts, we have improved the customer relationship. Will we do any adjustments? We will not do any adjustments. Perfect? Very good. Next. Increase in fair value of contingent consideration, this will be taken to P&L. Don't think this as a measurement period adjustment. You will not do any adjustment to goodwill or anything. Directly you will take it to P&L and you will adjust the contingent consideration, right. Now, this question covers, these two questions that we have discussed, covers almost all the adjustments that can come in the examination, right. What you have to do is be very careful in handling the purchase consideration, the NCI component and calculation of goodwill or capital reserve. All these working notes, plot them correctly in the balance sheet, your problem will be done. Okay. Don't get scared of this chapter just because the questions are lengthy or adjustments are difficult. Yes, I understand sometimes there may be very tricky adjustments. In that case, you can leave the question, but if it is a normal adjustment that has come in the examination, you should not leave this particular question, and high chance of these type of adjustments coming as a stand-alone MCQ in the examination, right. Okay. Now, let us continue our discussion on some theory aspects, and we will talk about reverse acquisition and common control transactions, and then we will conclude the revisions. When we talk about subsequent accounting, right, so whenever we have some specific items which you have acquired and how do we account for it subsequently, if it is contingent liability, higher of amount as per Ind AS 37 or initial amount minus revenue recognized as per Ind AS 115. So, whenever there is a contingent liability, we will check two things. What is the amount as per Ind AS 37? There is 1, let us say that comes as 100 as per Ind AS 37. Initial amount was, let us say, 150. Minus some adjustments of some revenue had to be recognized, which was 90. So, this becomes 60, 160, 100 is the higher, you will recognize the liability subsequently at 100. You will recognize the liability subsequently at 100. Okay. Then, reacquired rights, you will amortize it over the remaining useful life. Contingent consideration, if it is a liability, you will remeasure at every period end and take it to P&L. If it is equity, no remeasurement. Please keep this in mind. If there is a contingent consideration which is in the form of equity, you will subsequently not remeasure that part. Then indemnification asset on the same basis as indemnification liability. So, as indemnification liability changes, on the same basis your indemnification assets should also be changed. Then we have this concept of measurement period. What is this measurement period? If we have acquired another business, there are so many assets, so many liabilities, we are not able to determine the fair values, you can do accounting on provisional basis. They have said you do the accounting on provisional basis. Subsequently, if you get new information, but when should we get the new information? You should get within 1 year. It is not that I will keep on adjusting forever, then you will need one accountant only to do the acquisition date adjustment. They said within 1 year, determine all the fair values, whatever is the amount determined, use that and update the assets and liability and adjust the goodwill and capital reserve. If you get confused in the examination, just think of it, if I am increasing an asset, I have to reduce something. What will I reduce? I will reduce the goodwill component. If I am increasing an asset, I will reduce the goodwill and increase the NCI. Now, if the NCI is already at fair value, then you will not do that adjustment as far as the NCI is concerned. Then in that case, entire amount will be adjusted against goodwill. So, what you have to keep in mind, if it is partial goodwill, you will adjust both NCI and goodwill. If it is full goodwill, then you will adjust only the goodwill component, because NCI is already at fair value. Okay, so that is one thing you have to keep in mind. Then new information must relate to conditions existing on the date of acquisition. Right. Now, coming to the next part, as far as this is concerned, it can come as a MCQ question in the examination. Basically, what is a business? Now, Ind AS 103, when we talk about business combination, it is not talking in the sense of one entity acquiring another entity. One entity can acquire the assets of another entity. One entity can acquire the business of another entity as well. It is not just that you are acquiring the company as such or stake in the company. I can go and I can just acquire the business of another company. Even there, Ind AS 103 comes into picture. Now, as far as business is concerned, you must have inputs, you must have substantive process, and you must have output. Output is not mandatory, but you must have inputs and substantive process. By using both of these, you must be able to generate the output. If this logic is clear to you, you will be able to solve any question related to this in the examination. Okay. So, you just have to see that the process has to be a substantive process, and if the process is not substantive, it is considered to be an asset acquisition. So, you have inputs like what? Your machinery, your resources, your human resource, the technology and all of those things, those are inputs. Process, there is a process in which you convert the input to output. So, if you have both of these which can generate output, it constitutes a business. Sir, there is no substantive process, is there any business? There is no business. Sir, we have only inputs, no process, no output, no business. Sir, we have process, inputs, no output, it can still be a business if the process is substantive. Substantive means the process is important for you to convert the inputs to outputs in a very, very simple language, right? Now, if it is not a business acquisition, if I have acquired some assets of another entity, but it is not a business acquisition, then what should I do? Then I should consider it to be an asset acquisition, and I should do the accounting for asset acquisition as per Ind AS 16, Ind AS 38 and Ind AS 40. Okay. So, if I have acquired land and buildings, if I have acquired computers and all of those things, but this business test fails, then what will I do? I will do asset acquisition accounting and not a business combination accounting, right. Then there is an optional test to determine whether the acquisition is an acquisition of asset or an acquisition of a business. It is an optional test. If the management wants, what they say is, you check the asset concentration test, not acid concentration, asset concentration test. So, what is the meaning of that? Let us say I paid 100 to acquire another business. The value of a building itself is 90. In the entire business, there is a building or a land, the value of which is 90. I paid 100 to acquire the business. Now, tell me one thing, maximum amount I have paid to acquire one asset means I have not acquired a business, but I have acquired an asset, right. It is an optional test. Even if this test fails, you can do further evaluation, but what the standard says is, you do an asset concentration test. Now, how does this asset concentration test work? One, you check what is the gross assets required, the total of gross assets acquired. Then, what is the single identifiable asset value, asset or a group of asset, that is a single identifiable asset. You determine that value, and if the single identifiable asset is substantial, that is greater than 90% of the fair value of gross asset, then we can say the fair value of gross asset is concentrated in a single or a group of similar asset. So, either on a single asset or in a group of similar asset, if they constitute 90% of the gross assets acquired, then we can say the value that we have paid is to acquire an asset and not to acquire a business. Now, how will you calculate gross asset? You will take the fair value of consideration transferred, the total purchase consideration part, NCI, fair value of existing stake. So, basically whatever we have paid the owner's side plus any liabilities that we have assumed other than DTL, you will consider all of these to be gross assets. Basically, we are saying not net assets, but gross assets. So, whatever is there on the equity and liability side, we are summing them up. We will exclude cash, DTA, and of course, goodwill which arises due to DTL, right. This amount represents gross assets. There is a question in the study material, you can have a look at that question to have more clarity on this. This is called the gross asset. Then you will see a group of asset or asset which is recognized as a single asset, what is the value for that? So, say for example, if gross assets come to 100 and this becomes 95, then we say that whatever we have paid is concentrated on a particular asset. So, it is an asset acquisition. No, sir, it is still a business. You can do further check, evaluation and still consider it as a business. But if you are confused, you can use this test to simplify your situation. Okay, I do not expect a full-fledged question on this. Of course, an MCQ based question can come where you have to be careful about how to calculate this gross assets acquired. Then we have a concept of reverse acquisition. Now, what is this reverse acquisition? In case of a reverse acquisition, what do we do is, let us say IndigoLearn and let us say we have Reliance Industries Limited. IndigoLearn has 1000 shares in issue, Reliance Industries has 4000 shares in issue. What IndigoLearn does is, IndigoLearn acquires Reliance Industries. IndigoLearn acquires Reliance Industries 4000 shares by issuing 9000 shares. We issued 9000 shares to Reliance Industries, that is, let us say Mukesh Ambani. Okay. We issued 9000 shares to Mukesh Ambani and acquired Reliance Industries. Now tell me, in the combined entity IL and RIL, the names are also rhyming, IL and RIL in the combined entity, who is controlling the company finally? I am not controlling. Me, Sriram, Sarad, all put together we have only 1000 shares. 9000 shares are with Mukesh Ambani. Who is controlling? Mukesh Ambani is controlling. Now this IL is legally acquiring. Legal acquirer is IndigoLearn. But then RIL is the accounting acquirer, we say. Because in effect, the owners who were controlling Reliance Industries are controlling the combined entity. So even though they have not issued any purchase consideration, even though they have not issued any shares, we say for accounting purpose, RIL is the acquirer and IndigoLearn is the acquiree. Then how will we do? All the accounting has to be done as if the Reliance Industries has acquired. So calculation of purchase consideration, calculation, incorporation of assets, liabilities, everything will be done considering Reliance to be the acquirer. So what is the meaning of that? So RIL will determine what is the deemed purchase consideration kind of a situation. Then IndigoLearn's assets and liabilities will be incorporated by Reliance Industries in the consolidated financial statement. Sir, but IndigoLearn is acquiring? Yes, legally IndigoLearn is acquiring, but for accounting purpose, IndigoLearn is selling itself. So the assets, the liabilities, the fair valuation of all of that will be done for IndigoLearn. RIL will continue to show its assets and liabilities as they at their existing values, right? So the legal acquirer is the entity issuing the shares, but the accounting acquirer is the entity which controls the combined entity after the acquisition. What is the consolidation process? You will take the carrying amount of assets, liabilities and equity of the accounting acquirer. Now accounting acquirer here is Reliance Limited, or the one which has been legally acquired. Then you will compute the notional shares to be issued by the accounting acquirer and calculate the purchase consideration and goodwill accordingly. Now what does that mean? See, right now after the acquisition, IndigoLearn has 10% shares, Reliance Industries Limited has 90% shares. This is from the controlling point of view. Now if you say RIL has acquired, RIL has how many shares? RIL has 4000 shares. These 4000 shares give them 90% control. So how many shares should they issue to IndigoLearn? So we have to see 4000 divided by 90% into 10%. The number will come slightly odd. So 4000 divided by 90% multiplied by 10, if you do 444, 444.44, or you can just round it up to 445 shares. 445 shares will be deemed to have been issued by Reliance Industries to IndigoLearn. Okay, and that is how the purchase consideration and everything will be calculated. So there is a question on, I think, AX and BX. There is AX and BX which forms ABX. The question is there in the study material and also in our notes. ABX is the combined entity, then we have to decide either AX is controlling or BX is controlling. One of them will be the accounting acquirer. Okay, though legally ABX is the acquirer, for accounting purpose, one of these two entities will be the acquirer, right? So that you can have a look at it. So you will compute the notional shares as if Reliance Industries has acquired IndigoLearn, and you will do the accounting accordingly. You will calculate fair values and assets and liabilities of the accounting acquiree, that is in our example of IndigoLearn, and you will follow the normal consolidation process. There is nothing difficult, just once you can calculate these numbers, the rest all will be pretty simple and straightforward. Just be careful to calculate how many shares should the accounting acquirer issue. How many shares should the accounting acquirer issue? For that, what you will do? You will simply take the existing shares of the accounting acquirer. That becomes 90% in our case, that is their stake. For 10%, how many shares should we issue? Okay, I do a couple of times, adjustment, it will be done. Right? Then we have one more concept called common control transaction. That basically means that, let us say we have Reliance Industries Limited, you have Reliance Retail, and you have Reliance Jio. Reliance Retail and Reliance Jio. Okay. Now what does Reliance Industry do is, Reliance Industries merges these two entities, Reliance Retail and Reliance Jio, both of them are merged together. Even if they are merged together, RIL continues to control them. Earlier also RIL was controlling, now also RIL is controlling. Or let us say you have Reliance Industries Limited, then you have Reliance Retail, under this you have Reliance Jio. Reliance Jio is acquired by Reliance Industries Limited directly now. Now Reliance Industries directly controls Reliance Jio. Earlier also it was controlling, now also it is controlling. That is called a common control transaction. So what is a common control transaction? if the entities which are part of business combination are ultimately controlled by the same entity both before and after the business combination, it is called a common control transaction. Two subsidiaries of A Limited merge, both the subsidiaries are controlled by A Limited before and after the business combination. Very simple example. Now, what changes here is you will follow pooling of interest method and not the fair value method. So far everything we have done using fair value method. Now, what we will do? We will do pooling of interest method. Okay. Now, when you follow the pooling of interest method, all assets and liability of the acquiree will be taken at book values, you will not take at fair values. Purchase consideration in form of shares issued will be recognized at nominal value and not fair value. This is very important. So, all assets and liabilities book value. Purchase consideration, if you are issuing any shares, you will take at nominal value only and not at fair value. You will always take at nominal value. Assets other than cash is considered at fair value. In cash also is at fair value only. So, if you are giving any other purchase consideration, all of that will be recognized at fair value, but shares issued will be recognized only at the nominal value. The difference between purchase consideration minus share capital of acquiree is adjusted in the reserves. Now, this basically what it means is, because you are taking everything at book value, okay, everything you are taking at book value. So, if you are taking everything at book value, the net asset basically will be share capital and reserves, right. Now, whatever amount you have paid purchase consideration minus whatever is the share capital of the acquiree. So, whatever you have paid as purchase consideration minus whatever is the equity share capital of the acquiree, the difference that comes will be adjusted in the reserves. So, there will be no goodwill, there will be no bargain purchase, any amount that will be adjusted in the reserves only. So, for example, let us say there is an entity which has asset base of 100, okay, liability of 25, share capital of 30 and reserves of 45. Now, what happens is, let us say the purchase consideration issued is 50. So, what happens is you will debit asset at book value 100, then you will credit liability book value 25, you will credit reserves at 45 normally, and the balance whatever is the difference after purchase consideration you will credit equity share capital at 50 and whatever is the difference will go to goodwill, right. Now, here what you will do is, after incorporating all of this, what you will check is the share capital is 30 and I am issuing 50. So, 50 minus 30, 20. This 20 will be adjusted against reserves. So, you will not have 45, but you will have 25. Or the other way to look at it is, the other way for you to do it in the exam is incorporate all assets, incorporate all the liabilities, incorporate the purchase consideration, share capital, assets and everything. Whatever is the difference will be adjusted against reserves. No goodwill, no bargain purchase is recognized. Okay. So, when you do common control transaction, you will not be recognizing any goodwill or bargain purchase, right. The way you will account is incorporate all the assets at book value, all the liabilities at book value, difference will be adjusted against the reserves. That is the one thing. Now, the same concept is applied if there is a demerger accounting. So, if you are splitting a company into more than one entity, that is, there is one company which has two divisions, now we are creating two companies with one division each. That is also a common control transaction. Now, in the demerger accounting also you will follow the pooling of interest method. This method is called pooling of interest method. So, the original company is called the demerged company and the new company is called the resulting company. Original company demerged, new company resulting company. Now, as far as the demerged company is concerned, what they will do is they have transferred assets. So, liabilities transferred you will debit at book value, assets transferred you will credit at book value, and if at all the resulting company issues shares to the company, you will incorporate that investment in shares of the resultant company. If shares are issued to the company, you will incorporate it. The difference will be adjusted in capital reserve as gain or loss on transfer. But if the shares are issued to the shareholders, then this entry will not be there. Okay. So, if shares are issued to the shareholders, investment is not recognized by the demerged company. In most cases, demerger would be a common control transaction and that is how we will do the accounting. As far as the resulting company is concerned, they will follow the acquisition accounting using the pooling of interest method in most of the cases. Incorporate everything at the book value, compare that with the purchase consideration, and if there is any difference, it will be adjusted in the reserves, right. Now, with this, we have come to the conclusion of the revision of Ind AS 103. I hope you will find it useful before the examination to quickly go through all the concepts that we have covered. If at all you find something confusing, don't hesitate to go back to the full video lectures and revise it quickly before the examination. Okay, that is very important. Second, when you are doing questions, when you are solving questions, if you are stuck somewhere, if you are confused somewhere, that adjustment should be kept in a separate list. Okay, so that is what you have to do. Thank you.